Today we're going to take a look at the price of gold, its seasonal trend at this time of the year. It's starting to show a little bit of strength right here after correcting since August. And this has been a pattern that's actually occurred over the last decade or so, where we've seen corrections that have occurred into the tail end of the year, and then we've seen a rally in the strong seasonal period for gold, which lasts from December the 27th until mid to late January, and can move further on strong momentum as well. Now, the reason why gold tends to run at this time of the year is we tend to see larger consumption for gold from the Chinese retail at the Chinese retail level. Now, 20, 30 years ago, the Chinese individuals, it was very difficult for them to buy gold, and now they're actually large consumers of gold and go back and forth with the world's biggest consumers for gold with India, depending on the year at this time. So we tend to see this strong seasonal period for gold late December into January, and even into February, and sometimes into March as well. But if we take a look, I want to take a look first at the relationship between the real interest rates and the price of gold, and because it's important to follow some of the other factors, because if we come up with a seasonal period and some of the other factors line up to help support the price of gold, then gold can really make quite a strong move. And the last few years, the price of gold has been greatly influenced by the real rate of interest, which is the nominal rate of interest that we hear all the time in the news, minus the inflation rate as well. So if you can take a look from the mid-2000s, the blue line represents the real interest rates as proxied by the 10-year inflation index security. This is the yield that's on the scales on the left-hand side. You can see real interest rates actually decreased, and at the same time, in this time period, the price of gold actually increased. And the reason why gold tends to increase when the real interest rates decrease is the opportunity cost of holding gold goes down, and therefore it makes it more valuable. And you can see here in 2013, we saw real interest rates uptick here at the time. And what happened to gold? Well, it went down. And then we saw this back and forth between gold and the real interest rates. And then in 2018, we saw this uptick in real interest rates. That's when Powell was getting serious about being hawkish and trying to get the economy back on its footing and have a buffer zone for the future. And then we saw the pivot that took place. So right as he was getting serious, the price of gold went down. When he pivoted, and then the market bottomed on December 24th, 2018, then what happened to real interest rates? They went down, and the price of gold has done very well from there. Now, gold's actually corrected really since late August. And then what's happened with that is we've seen the real interest rates increase over this time period. Why have they gone up? Because inflation expectations have increased as we've gone into the reflationary trade. The cyclicals have performed well in that time period, and therefore the real interest rates have moved up, and that's actually hurt the price of gold. So as real interest rates have gone up, gold has gone down. But it's interesting to note, just in the last little bit, we've started to see real interest rates go down. So the expectation for inflation in the future has decreased a little bit here. And what's happened? The price of gold has actually come up here a little bit, just as we're starting the strong seasonal period. This is important because this correction into this time of the year tends to lead to a good seasonal opportunity. If we go back over the last decade and take a look from 2010 at the price of gold, this is gold on continuous contract on the CME. You can see here that in 2011, look at this bottom. We saw this big correction take place into December, and then gold rallied very sharply into 2012. And if we go to 2012, you can see here that towards the end of the year, now gold was actually starting to head down because real interest rates were going up at the time. But gold still did well, relatively speaking, at least compared to its overall trend line here, towards the end of the year and into the new year, and then it corrected as real interest rates actually upticked. But if we look at 2013, towards the end of 2013, 2014, we saw this bottom being put in. Once again, this big correction for gold, finishing off towards the end of the year, and then a rally into the beginning of the new year. And then 2014, the bottom actually occurred in October. So a little bit earlier, but the major move really was in late December into January. 2015, the bottom occurred in November. Really, once again, the major move was in the part of the new year. Then 2016, December. Then 2017, December. Then 2018, right? That was when Powell was doing his hawkish to dovish scenario. The actual bottom took place in October, but really it was once Powell pivoted, we saw gold actually do quite well here. And then last year in 2019, coming into 2020, we saw the bottom actually in November. So we saw that correction take place, just like very similar to what's happened here, and then gold rallied very strongly. Now, it doesn't mean the same pattern is going to take place again, but we've seen this pattern fairly consistently over time, and it is something to watch out for this year. We're starting, we're well set up, having corrected, coming into towards the end of the year like we have in the previous years, and this is set up for a strong seasonal bounce. And if the real interest rate starts to decrease, that could actually provide some more benefit for gold as well. So something to watch out for as we enter into the seasonal period for gold. Thank you.